Forget everything you think you know about the stock market. For the last 3 years, Nvidia wasn't just a ticker symbol on a screen. It was the new American religion. If you owned it, you were a prophet of the future. If you didn't, you were a heretic left behind in the old world. But this morning, the pews are empty. The high priests of Wall Street are sweating through their suits. Why? Because the most expensive infrastructure build-out in human history just hit a $700 billion brick wall. Since 2023, Nvidia added $4 trillion in market value, a figure larger than the entire GDP of Germany. But look at the screen today, in February 2026. The stock is shivering. 10% drops in a single week are becoming the new normal. Wall Street isn't just correcting, they're panicked. And it's not because the chips stopped working. It's because the AI circular economy just caught a fever, and Nvidia is patient zero. Let's talk real data, the kind they don't put in the glossy, buy the dip videos. For the last 24 months, Nvidia has been playing a high-stakes game of financial musical chairs. Analysts are finally sounding the alarm on a phenomenon called circular funding. It sounds like complex finance, but the premise is hauntingly simple. Nvidia has funneled over $50 billion into private AI startups, names like CoreWeave, Lambda Labs, and even OpenAI. In fact, Nvidia is currently nearing a massive $20 billion direct investment in OpenAI's latest $100 billion round. These startups then take that exact venture capital and spend it. Guess where? On Nvidia chips. On paper, this looks like record-breaking organic demand. It drives the beat and raise cycles that sent the stock to the moon. But to a seasoned auditor, it looks like a ghost demand loop. Critics are starting to use the word vendor financing, a practice that famously preceded the collapse of giants like Lucent and Enron during the dot-com bubble. When a company is essentially buying its own revenue, the growth isn't just artificial, it's fragile. If the startups can't turn those chips into a profitable business, the whole merry-go-round stops. And as of today, those startups are burning cash at a rate that would make a Silicon Valley veteran blush. Then there is the hardware itself. The infinite money glitch has finally started to lag. Reports have confirmed that the Blackwell Ultra chips, the supposed crown jewels of 2026, are hitting a physical limit. It's not just about the price, it's about physics. The Blackwell systems are facing significant overheating issues in high-density server racks. Each processor draws over 1,000 watts of power. When you pack 72 of them into a single rack, you aren't just building a computer, you're building a furnace. This thermal crisis has forced major redesigns and shipment delays. When the king of AI starts seeing customers like Microsoft and Amazon scale back their Blackwell orders to buy older Hopper chips instead because the new ones are literally too hot to handle, the empire doesn't just slow down, it fractures. Now, look at the big four. Amazon, Google, Meta, and Microsoft have officially committed to spending a staggering $700 billion on AI infrastructure this year alone. To give you perspective, that is enough money to buy every single team in the NFL, the NBA, and the MLB, and still have enough left over to buy the entirety of Disney. For 3 years, shareholders cheered this spending. Now, they want blood. The return on investment simply isn't showing up. Investors are looking at Amazon's $200 billion capital expenditure and Google's projected $185 billion bill and asking a simple, terrifying question. Where are the profits? We have moved from the era of fear of missing out to the era of capex fatigue. The data is showing the first signs of inventory bloat. For the first time in this cycle, Nvidia's data center sales are showing cracks. Wall Street is terrified that big tech has overbought. If these giants decide they have enough silicon to last through 2027, Nvidia's revenue doesn't just plateau, it falls off a cliff. Think of it like a buffet. Microsoft and Meta filled their plates 3 times over. and now they are sitting back, full, unable to take another bite while the bill is still being calculated. Nvidia's greatest strength was its monopoly. You paid the Jensen tax, $40,000 for a single GPU, or you didn't get to play in the AI era. But today, the hostages are revolting. The rebellion is silent, and it is made of custom silicon. We are entering the ASIC acceleration point, where in-house silicon is starting to outship generic GPUs. Amazon has launched Trainium 3, claiming it trains models at half the cost of Nvidia hardware. Google's TPU v7 is now generally available, and reports suggest Meta is shifting billions in spending away from Nvidia and toward Google's chips. These in-house alternatives are 30 to 40% cheaper for these companies to run than anything Nvidia sells. The competition isn't just internal. AMD has finally reached software parity. Their MI350 platform is finally a viable alternative to Nvidia's CUDA ecosystem. Meanwhile, the geopolitical landscape has shifted into a state of permanent uncertainty. While the U.S. government recently eased some export curbs on older H200 chips to China, it slapped a 25% tariff on them and introduced the AI Overwatch Act, which allows the government to revoke export licenses at any moment. Nvidia's market share in China is projected to collapse from 66% to just 8% this year, as Chinese giants like Huawei and more threads fill the void with domestic hardware. That is a multi-billion-dollar hole in the balance sheet that sovereign AI deals in Europe simply cannot fill. But perhaps the most chilling data point isn't in the sales figures. It's in the personal bank accounts of the people who run the company. Since the start of this year, senior insiders have dumped hundreds of millions of dollars in stock. SEC filings from just this past week show that CEO Jensen Huang has executed over 200 separate sales, offloading millions of shares. In the last 6 months, there have been 364 insider trades at Nvidia. Every single one of them was a sale. There were 0 purchases, not one. When the people who know the secret roadmaps, the yield rates, and the true order volumes are cashing out at record levels, it sends a signal that the valuation has reached nosebleed territory. Nvidia is trading at a price-to-sales ratio that has historically signaled a bubble burst for every tech leader of the last 30 years. From Cisco in 2000 to Intel in the 90s, the names change, but the math is a universal law. Is Nvidia dead? No. It is still the most advanced hardware company on the planet. Their upcoming Rubin architecture, slated for late 2026, is a masterpiece of engineering. But the panic of 2026 isn't about whether Nvidia is a good company. It's about the fact that they were priced for a perfection that no longer exists. You cannot grow at 200% forever when your biggest customers are now your biggest competitors. Wall Street is panicked because they realize Nvidia is no longer a guaranteed bet. It is now a battleground. The era of easy AI money ended this morning at the opening bell. Now Nvidia has to prove it can survive in a world where it is no longer the only game in town. Because on Wall Street, the bigger you are, the harder the ground feels when you finally trip. And for Nvidia, the ground has never felt closer.